All right, Kate, thank you very much. Like I said, if Elon Musk just happens to walk by, I'm going to try to grab him. We'll get some. Yeah, well, not right now. I'm going to do the show, and then I'm going to go try to find Elon.
Okay.
Hey, Rudy,
let us know.
Exactly. We'll do this. All right. Some of the biggest money managers in the world are right here in the Beverly Hills Hilton for the Milken Institute Global Conference. A big week for your money as well, because it's not just this conference. You got the Federal Reserve meeting tomorrow and then making the interest rate decision on Wednesday. We're in the middle of really a pretty good run for stocks coming off an absolutely lousy start to April. So let's get some opening insight from our leadoff panel now. Collectively, they help manage nearly $800 billion. That's real money even for here. George Maris is Global Equities CIO, Principal Global Investors, and Kevin Jestice is Head of Investment Management at Nationwide, and I'm told a new face to CNBC.
Thank you, Brian.
Good to have you both on. George, let me ask you this. Terrible start to the month. Unbelievable rally back. If we finish higher for the S&P 500 today, it'll be, I think, a 10-day win streak, the longest in about 20 years. Your guys both kind of work on the insurance side. Your job is preservation of capital for the most part. What are your clients saying right now? What are they worried about right now?
So I think, interestingly, our clients are highlighting the fact that this is an interesting opportunity to make money. Given a lot of the dislocations we've seen over the last month, there's a lot of securities out there that are still down 25, 30% on no fundamental change whatsoever, just on market factor rotation. And so there is actually an interest in our clients on how to use this period of dislocation to make more money. Even though the market's rallied hard, it hasn't rallied everywhere. And so it's created substantial opportunity.
And Kevin, you've said you've got some data that your clients are actually net buyers, not net sellers.
That's right, Brian. We're seeing retail investors buy on the dip. And historically, we haven't seen that. Institutions tend to buy the dip better than retail investors. But retail investors are setting emotion aside and really buying on the dip and seizing an opportunity. The 8, 10, 12% down period we had a few weeks ago, retail investors were coming in pretty strong. That's really good for their long-term retirement savings.
Why is it good? I mean, markets can continue to go down from here.
They can, but...
And they have.
If we offered you the shirt you have on at a 10 or 15% discount, I think it was a pretty good deal. For some reason, we don't like to buy stocks when they're on sale. But if you're saving for 20, 30, 40, 50 years for your retirement and your longevity and maybe to leave something to your heirs, whether you get the 12 versus 15 right now really doesn't matter in the long term. And investors are doing a great job buying stocks at a discount for the last 3 or 4 weeks.
You sound a little bit like Warren Buffett, who on Saturday was talking about this downturn and said, well, it's not really anything, it's just investing. Now, that's easy to say if you got $330 billion in cash and you're worth a couple billion bucks. That said, George, most of your clients probably are not Warren Buffett. It's scary when stocks go down.
It is scary, but I think what people have been conditioned to, and why do we see hedge funds become very short, is a different time horizon. Hedge funds have a very short time horizon. We're seeing market structure, algorithmic traders, systematic traders, sometimes days, sometimes weeks, at most a month, where you have a lot of retail folks who are sitting there who believe in the long-term trends that they're seeing and are willing to buy now because they see the next 5, 10, 20 years in a much more attractive way.
And a lot of those, by the way, those hedge funds and algorithmic traders, they're here in this room right now. Is that one of the reasons that markets are whipsawing as fast as they are? And I try to explain that to people as well and say, listen, this isn't 20 years ago. Okay, we're not calling E.F. Hutton and selling 5 shares of IBM. You could sell $1 billion in a stock in the less than the blink of an eye. So should we be prepared? And say no if it's not true, for markets to move up and down faster than ever.
I think without question, markets are going to be way more volatile they are now relative to where they were 10, 20 years ago than they will be going forward. Market structure has just changed. 20 years ago, it was a bunch of long-only mutual fund managers, long-short hedge funds that traded on fundamentals. Today, it's folks that are trading on stochastics, on mathematical factors. The fact that we have trillions of dollars that trade in options on zero-date deliveries, is insane, and it creates this incredible short-term volatility that is, I think, somewhat separated from long-term fundamentals.
Yeah, I think, Kevin, I know it's not your world necessarily, but I'm sure you have a view. Warren Buffett also called all these derivatives like weapons of mass destruction, financial weapons of mass destruction, because they can be very good. They can make stocks go up more, but they can also make stocks go down more. How do you manage your world and not get distracted by all this stuff?
So those tools can definitely accelerate the velocity of market movements, right? And that's the risk inherent in them. Warren Buffett also said at the recent meeting, though, that you don't need a high IQ to be a great investor. You need a calm and stable temperament. And so we constantly remind ourselves to pay attention to the fundamentals, to valuations, and hold true to a long-term plan. For retail investors especially, stay true to your long-term plan. Develop a plan with a financial advisor and stay true to it over the long term.